Woohoo! We made it, episode 400. I'm Rob B, of course, with Rob D, and you are listening to the Property Podcast. Gosh, we're getting old. But with age comes experience, and we're going to pass that on to you in this episode. So not only when you make your mistakes, which you will, you'll be able to not just learn from them, but profit from them as well.
Welcome to the Property Podcast, where every Thursday morning, property investors come to be informed and inspired. And you know what? Some diehards have been doing that for 400 weeks now. Yes, this is episode 400 of the Property Podcast. But don't worry, we are keeping self-indulgence to a minimum. Yes, we are talking about our experiences over the last 400 episodes. But more importantly, we're talking about you. We're talking about change and how and why you need to adapt. So that's coming up after our news story, and stick around to the end because I'm going to share a recommendation for a podcast that I've been absolutely loving.
So this week we have a massive news story that nobody is talking about. There's apparently a few other things going on in the world that people are giving their attention to. But for us, and it should be for you listening, this is a massive news story. And the news story is that the Bank of England pumps in another £150 billion of QE into our financial system. Now, you may be going, Rob, QE, it's kind of old hat. We do that all the time. But that's the point. We do it all the time. And this year, we've done it more than ever before. So, Rob, do you want to give people a bit of a timeline of QE since 2009 and why this latest round makes it a record breaker for 2020?
I will, because when you say 150 billion, you go, well, is that a lot? I mean, obviously it is a lot, but in the scheme of things, is it a lot? It's hard to know. Well, let's put it in context. The first ever round of QE was in November 2009. That was 200 billion in response to the financial crisis. So that already tells you something about what's just been announced. 200 billion in response to the entire financial crisis and 150 billion this month alone. They then did another 175 billion in July 2012. That was to try and get inflation up. They then did another 100 billion or so in 2016. That was in the aftermath of Brexit. But then it's 2020 where things have got really interesting. So in March this year, they did 200 billion. In June this year, they did another 100 billion. And just now, as we've heard, they've announced another 150. So purely in 2020, obviously as a response to coronavirus, the cumulative amount of QE from the Bank of England has doubled effectively. So what's been done this year matches what was done in response to Brexit, the financial crisis, and everything else that happened in the 6-7 years when things were looking severely wobbly. It's kind of unbelievable, Rob, that this isn't more of a story.
I know. It's incredible. The amount that's gone in this year is more than ever before. But QE in the past has made such a huge impact, and its impact on asset prices. And if you go back and look at asset prices after QE has gone into the system, you do see a rise. But this time we've had more QE than ever before. And you might be thinking, well, we're not seeing any asset prices go up at the moment. And you're right, because the system is obviously under severe stress. If the economy hasn't collapsed, and if the financial system hasn't collapsed, then this QE is going to be ready and waiting to make an impact. It doesn't just disappear. It's going to be used. And the direct implication is asset prices will go up. So once things settle down, you've got this tranche and all the other tranches that have gone in this year ready to make an impact. And Rob, I wouldn't be surprised if there's more down the line. We will see. I think if you're interested in this, you want to go back and listen to episode 179, where we talked about QE and how it impacts property prices. But this is a subject that we probably should tackle in a not too distant future, again, because it is so interesting. And the impact against property prices is huge. It's something that all property investors need to understand.
It's hard to believe this, but this is episode number 400 of the Property Podcast, which means we've been going for nearly 8 years now, every single week without fail, and for many years now, twice a week. As you'd expect, a lot has changed during that time. A bit worrying if it hadn't really. A lot has changed for us personally, a lot has changed for us professionally, and a lot has changed in the property market in general. The nice thing about hitting milestones is it makes you look back and think about how things have changed over that time, whereas normally you're fixated on the future. But there are important lessons to come from looking back, so I think it's really important to do that every so often. And in this episode, we're going to look back over the nearly 8 years covered by these 400 episodes of the podcast. We're going to look back at some changes that we've made to the way we invest. We're going to look at some things that we've changed our mind about. And we're also going to look at the changes that we've seen lots of other people making during that time and the importance of adapting as an investor in general. Because if you tried to invest today in the way that everyone was back when we started in 2013, it just wouldn't work. And I'm sure if you tried to invest the way you do today, in another 7-8 years, well, the world will have moved on again.
Yeah, it's a bit crazy when you actually reflect on those 400 episodes gone and how much has changed. It's substantial changes. And we've made massive changes ourselves. And early on in our investment journey, while we were podcasting, probably the biggest shift to our thinking was the discovery of the 18-year property cycle. Now, the 18-year property cycle as a subject is probably the subject that we're probably known best for talking about. It's something that we've covered a lot because we really think it's important for people to understand market cycles. And the 18-year property cycle hugely shifted for us our thinking on how we should act as investors and gave us a better insight to how the markets do move. Rob, do you remember when you first discovered the 18-year property cycle? I can't remember the exact timing and dates, but what I do remember is just being like, wow, this has just changed my whole paradigm of property investment. My thinking has completely shifted. And it's not very often you get such huge shifts in thinking. Do you remember when you first read it and what sort of impact it had on you?
Actually, do I remember where I was? It's like when Kennedy was assassinated. No, actually, I wasn't around.
Well done, you.
But I was in Prague at the time, and somebody sent me an article that was a cover story of Money Week magazine. It was written by Akhil Patel, who's now a friend of the podcast, and Phil Anderson, and it was talking about the 18-year property cycle. And I just remember reading it and thinking, wow, and then like immediately reading it again. Then I sent it on to you, and then I think we talked about it the next day and recorded a podcast about it quite soon afterwards. I think the reason it had such impact was it just made so much sense. And so many things that we could see in the world all suddenly seemed less random. And this idea of the cycle explains so much. And for me, that's the core of the whole idea of the cycle. It's like, at first, the 18-year bit seems like the exciting bit because you do go, oh, wow, well, that we just need to count forward this far. And then you can see exactly what's going to happen. So I know when to buy, I know when to sell. And to an extent, that is true. You can use the 18 years to be more accurate than you would be if you didn't know about the cycle. But for me, it's not about the 18 years. It's about the sequence of events that markets go through and the fact that you can look to what's going on in the world. You can look at signs around you to get a sense of which phase you're in. That was such a powerful idea when we encountered it for the first time.
So we discovered this nearly 8 years ago, Rob, and we've been able to live through it during that time. How do you think it stood up as a concept over the last 8 years with all the changes that have happened? Do you think it's still valid? Do you think it's valid more than ever, or do you think it's not as strong as a concept that we once thought it was?
We ended up talking about this quite a bit around April, May, June because we had COVID. That seemed like something that could potentially derail the cycle. And I think that's actually going to be the real test of whether it is valid or not. And this is something we talked about earlier in the year. If we have a property crash in 2021, then the cycle hasn't worked. That doesn't mean it won't work in future, but this was such a massive event. It's the equivalent of a world war. The whole thing falls apart. If it doesn't, and we start seeing the signs around us that indicate that people are getting excited again and things might start getting a bit frothy, then we can be fully on board. I don't think you can pass judgment at this stage. And there's certainly been a lot of people questioning it because for the last few years, the market seemed to be going sideways. We seem to have that initial growth part of the cycle. Then we've had the pause, and the pause has just kind of kept on going. So I don't know about you, Rob, but for me, can't say, yes, absolutely, you've set my clock to it, 100% confident when the cycle's going to end. But I've certainly seen enough over the last 7-8 years that I still believe it to be a useful tool.
For me, Rob, it's so far so good. Of course, you can't judge it until the cycle's completed, and then we'll know for sure. But you only have to look at London property prices and how they've performed, initially strongly, and then softening to most people's surprise. As an example of the 18-year property cycle mapping out and working, you only have to listen back to episode 224, and the episode was called How to Predict Future Property Prices, where we mapped through the last 18-year property cycle. And we discovered for the first time that actually London in the last cycle did really well in the first half again, and then softened, and the North and the Midlands were the power that took us through the second half of the cycle, and they were the areas with the most gains. And that so far has seemed very much to play out, and it helped us make predictions about where future growth cities will be. And we got a little bit wrong as we called the end of London too soon, but we got a lot right as well, and kind of built up a fair bit of credibility off the back of it. And all we were doing was using the 18-year property cycle plus a bit of common sense to say, well, actually, these areas should do better now. And now that's happened, it's easy to go, oh yeah, fair enough. But when we said these things, we were very much going against the trend. London was still strong, and the cities that we went on to talk about hadn't performed yet. But it was using the 18-year property cycle that gave us that confidence to make those predictions. And Rob, over the 400 episodes, our obsession with cycles has continued. And more recently, we've talked about Ray Dalio and his general economic cycles. Initially with his video, How the Economic Machine Works, which is a great video, which everyone should watch. You can find it on YouTube. To more recently, some of his very in-depth articles on LinkedIn that are, while heavy going, really, again, help us make sense of what's happening in the world right now.
Yeah, definitely. We talked about Ray Dalio's work just a few weeks ago and tried to make it a bit more accessible. It is a bit long and weighty. Learning about that for me was very much like the 18-year property cycle. A lot of things suddenly made a lot more sense, and it gave me a lot more confidence in predicting what the future is going to be like. Not exactly, not year to year, but the general shape of it. And learning about frameworks like this for me just makes everything seem less random and easier to make sense of, which is, of course, very important as an investor. And I know you're the same, Rob, but in general, not just cycles, but learning more about economics and the macro side of things has been really important to me since we started the podcast. And I can't anymore see property on its own in isolation. You have to look at it as part of this system and in relation to all other investments and in relation to interest rates and all these things. And it makes everything a lot more complicated. You can't go, oh yeah, there's a house and I can see how much I can rent it for and that's all good. But it also makes it, for me, a lot more exciting.
It does. It makes it more exciting, but also less scary. Like, you kind of get a better feel for what's happening. And when massive events come along, while it may shock and scare other people, at least from a economics point of view, I'm not that rattled by much these days, because most things that play out have happened in the past in some shape or form already. We've had pandemics before. We've had low interest rates before. We've had trade wars before. All these things aren't new phenomenons. And when you look back, it helps you get a lot more confidence for the future. Another thing that's been really interesting over the last 400 episodes is we've had some strong views and we broadcast them on the podcast because we truly believed them at the time. And then as time has been our teacher, we've learned actually our viewpoint back then may not have been right, and at least not right for us. And one of those views that we probably should discuss, Rob, is that we said quite strongly that you should never sell a property. Never sell a property. And you know, there was very little wriggle room around that. And even recently, Robert Kiyosaki, who we had on the podcast, was saying something quite similar. But I know I certainly have changed my mind on this, so much so that I have, during the last 400 episodes, sold one of my properties and will sell more in the future. So are we allowed to change our mind, Rob? Should we go and scrub those old episodes out in case people don't get through to episode 400? For you, what are your thoughts on this subject now? And would you sell a property?
Well, we do sometimes hear from people who went back and started at episode 1. And I do kind of think, I really hope you don't get sick of it by episode 50, because we've certainly learned more and evolved our views over time. And I think that's okay. That's healthy. Learning in public can be a valuable thing as long as you're willing to admit where your views have changed. And Never Sell a Property, I think, is the perfect example of this. We started with something that is very simple, very firm, and sounds true. Never sell a property. Makes sense. Property prices always go up over a long enough time frame, so why would you sell? Seems very sensible. But then as you learn more, you learn that there's a bit more colour around these things, and there are situations where this doesn't apply. I've sold a property as well. It didn't fit my strategy anymore. It was the right time to sell. It was the right thing to do. No regrets. Not even if I look back at what that property's worth in 10 years' time, because I've reinvested in another property. So there are lots of reasons why actually selling a property could be the right thing to do. It might be a specific property that you thought would perform but hasn't. It might be that the time is right to deleverage. It might be that your goals have changed. It might be that you want to diversify away from property in general. Loads of reasons. We talked about that more back in episode 134. So at least we saw the light on that within the first few years. But for me, I think the lesson from this is those kind of firm rules of investment are maybe somewhat helpful when you're getting started, but they can start to lead you in the wrong direction as you build your knowledge and as you progress.
So that's a belief that we've had changed over the last 400 episodes, and there are others too, but we just wanted to give you an example that we're not always right, and there are things that we will change our mind on, and most importantly, be willing to change our mind on. We've not let our egos get in the way and gone, wait a minute, we've made a stance on that, we've got to stick to it now, because not only would that make us look silly, but it would also cost us money. So I'm really pleased that we are open to change, and the thing with a podcast is you're kind of held accountable to it. You're broadcasting your thoughts week in, week out, and you know what, sometimes you are going to get it wrong. And sometimes your beliefs change, as a property investor over time, but also the market or external circumstances will make you change. Because every property investor had to change, or at least should have considered changing their approach around the tax changes that came in a few years back, which essentially meant that property investors could no longer offset their mortgage costs against their rental income. Now, clearly, there's a bit more to it than that, but the upshot was that many of us were investing through our own names, and then after digging a bit deeper and understanding our situation, we realised that it's better to invest through a limited company. And that actually opened my eyes up to investing more efficiently. I probably should have been investing through a company already. So it was an external event that made me change, Rob, but actually I probably should have changed sooner anyway.
Yes, tax is a great example of what's changed, because when we started 400 episodes ago, it just wasn't really talked about. Of course, some people did invest through companies, but doing it as an individual was so much the default that it just didn't really come up in conversation. That completely changed things. And while it would be a stretch to say that on balance, that was a positive thing for investing in property as a whole, you, Rob, have clearly used that as a positive, as have many other people. I'd bucket things around legislation changes in there as well. The amount of new regulations and changes that have happened around renting out property that have changed in the last 7 or 8 years has been absolutely unbelievable. There's so much more that you need to be aware of now than you did back then. And again, that's something that everyone has had to adapt to. You had to. If you try to just rent out a property casually on the side, without having educated yourself and without having thought about it much, at some point you're going to get yourself into a world of trouble because so much has changed. Well, that's been massive in the property world, but then in the country and the world in general, there's been massive things going on. Brexit, or rather everything around Brexit, because it still hasn't happened yet, has been a factor for investors for getting on for 4 years now, half the life of the podcast, unbelievably. And as soon as that seems to be coming towards something of a conclusion, then you've got COVID, which I'm sure we'll be talking about for a long time to come. So as investors, Rob, you and I have had to adapt to this and learn about it all and think about what it means to us and change our approach. And everyone else has had to do that as well.
Absolutely, Rob. And for me, this is the big lesson for everyone to kind of absorb today is the willingness to change. Sometimes changes are forced upon you, like external factors that we've talked about. And you can try and resist that if you want. No, I'm going to stay investing through my own name, or no, I'm going to stick to this strategy, even though external factors have made that a lot more difficult to work with. You can do that, but that's going to really cost you money, and that stubbornness is actually a bit stupid. And if you are that way inclined, it's going to be really hard for you as a property investor over the coming years, because change seems to be the constant in the world right now, and you have to change and adapt. But if you're willing to, then you can take advantage of situations, particularly if you're quick to move. Don't be emotionally attached to the way you invest right now. And also don't be emotionally attached to your beliefs. This is the harder one. External factors and you having to adapt and change. It's easy to rationalise. It's easy to get your head round, for most of us anyway. But realising the strategy that you started with might be not optimal or possibly even wrong for you, or some of your beliefs that you have around property investment and the economy are wrong as well. Acknowledging that, accepting that really then is when the success comes. But, okay, you've got to accept that you've made mistakes, but you learn from them and you become a much better property investor. The internal changes around your beliefs are the ones where the most growth will happen for you personally and probably financially as well. As I touched on, Rob, we document our thoughts every week, so we kind of have to accept that things are going to be wrong. And thankfully, we haven't been ridiculed too much by people for changing our mind on different things. And I think it's okay to do it. And that's what we want to get across here, is that we are the hosts of the Property Podcast. We're the ones imparting our advice and knowledge over to you. So hopefully that assists you as property investors. But we've clearly been wrong on some of our beliefs. We've clearly changed our strategies as we've gone along. And that's okay. It's fine to do that.
It's not only fine to do that, I think it's essential to do that. And this goes beyond property as well, but property and investment is such a good place to see it, because when you invest, if you're right, you make money, and if you're wrong, you lose money. So you see the consequences of being right, and being right feels very important. So when we started doing the podcast, London was performing better than anywhere else in the country. So that's something we will have said on the podcast, London's doing better than anywhere else. But wouldn't it be bizarre if we stuck to the belief that London was the best place to invest in the country, even as the years went on and it became not the best place, and in fact one of the worst places to invest? It'd be really weird if, in the light of all the evidence, we continue to insist that it was the best place. Same for investing as an individual rather than as a limited company. When the world changes, it makes sense to change your views. And when you thought something was true, but then you discover clear evidence that, in fact, it's not true and you were wrong, then you should change your mind as well and admit it. It's nothing to be embarrassed about. Having an accurate view of what the world is like, which is what being right is is really important. And actually, Rob, I think changing your mind, learning, adapting, gradually getting closer to the truth is a good thing. It's a really important thing. And in the context of property investing, it's a profitable thing to do.
It is. Embracing the change is something you should do. Resisting it is only going to hurt you one way or another. And embracing the lessons from your mistakes or your inaccurate viewpoints is also important. It's a saying that I've kind of used a few times in the past, but it really rings true for this episode, which is the person who thinks they know it all is the biggest fool. If you think you've got all the answers today and that's going to set you up for the future, well, then you're a bit of a fool. If you really truly believe that. If you know that your plans that you have today are probably going to change, adapt, you're going to make mistakes, and you're comfortable with that, and not only are you not comfortable, but you're willing to learn from them, then you're going to be great. You're going to do well as a property investor and probably in other aspects of life as well. So don't be stubborn. Don't resist the change. Don't resist lessons and accepting that you're going to get things wrong, but actually embracing it and going, wow, I'm going to learn, and that you're going to become a better property investor and possibly even a better human being. So it's time for Hub Extra now, where we want to give you more. And this is all backed up by our Friday email that goes out to all Property Hub members. And it's easy to be a Property Hub member. You just go to propertyhub.net and sign up, and you will receive the Hub Extra email. And it's a cracker. There's loads of good stuff in there every week. But we do a mini version on the podcast where we want to give you a little bit extra, a little bit more. And this week, Rob, it's a bit of a follow-on because you've previously recommended a book which was called A Bit of a Stretch on the podcast before. But now you've got a Hub Extra that's an extension of that previous Hub Extra.
Yes, less than halfway through the year, I called A Bit of a Stretch by Chris Atkins as my favourite book of the year. I just didn't see how anything would beat it, and it hasn't. It's a book about his experiences in Wandsworth Prison when he was serving time for tax fraud. It's really, really funny. It's really, really sad and scary as well. An amazing book. And so I was so happy to discover this week that he's now got a podcast on the same topic and of the same name. It's called A Bit of a Stretch, the podcast. And in the podcast, he talks to former prisoners about their experiences. And so because you can actually hear them and get to know them a bit, the funniness and the sadness and the scariness just comes through even more. It's really well done. It's a really powerful listen. Strongly, strongly recommend it. And you'll find a link to that along with everything else we've talked about today in the show notes for this episode.
So that's us done for another week. We'll be back on Tuesday with Ask Rob and Rob. And we'll be back with episode 401 next week. For those who've been listening for a while, thank you. For those who've just joined us recently, thank you too. It's been a pleasure recording these episodes week in, week out. We absolutely love it. It's fun for us, and we're just glad that you enjoy it too. Thanks for supporting the podcast. We can't wait to bring you another 400. Cheers, everyone. Bye-bye.
Bye-bye.